which is Learning Unit 4. It's a self-assessment question. We'll try to cover that question as well. So shortly, we're just going to start by covering inventory. The standard, I will try to explain few concepts as we go along. You will have to forgive me if we have any IT issues. Honestly, at this point, not 100% tech savvy, but we've got all proper support that we need. So if anything that I'm working on is not appearing on your site, please do indicate for me so that they can be able to help me quickly. We are currently working on inventory, IS2. So I'll briefly go through the standard itself, and then immediately then we're gonna jump over and do the questions. So inventory by nature, it's an asset. One, it's an asset. So we've already, when we were doing our framework, found the definition of an asset. So the asset itself is defined in terms of the new revised conceptual framework. So that conceptual framework is what we have on tutorial letter 103. So the definition of inventory is also covered in terms of your study guide. If you can go with me on your study guide on page 55, on 4.1, they say the nature of inventory. Inventories include both tangible and intangible assets that are held for sale, in the process of production for sale, consumed during the production of saleable goods or services. IS2 does not apply to certain categories of inventories and applies to certain inventories. So most of the time you will find out in the study guide they refer us to the textbook. So one, they say inventories are both tangible and intangible assets. They are held for sale in the ordinary course of business, in the process of production for sale, consumed during the production of saleable goods or services. Now, this last one will be unpacking on it today, because we'll be also touching on things such as your NRV, which is your net realizable value. So this is by definition what we are looking at when we are looking at inventories. Assets that are held for sale, assets that are in the process of production for sale, and those that are consumed during the production for saleable of goods. Then the next thing that we look at is the measurement of inventory. So what is important in terms of the measurement is, one, inventory is always measured at lower of cost or net realizable value. So there's always two measurements of inventory that you'll always find. It's either it's the cost or it's the net realizable value. We'll touch later on the net realizable value. And then you have to always be aware when you are measuring your inventory in your disclosure, which one must you apply, either cost or net realizable value. But it is measured at lower of cost or net realizable value. Now, on cost of inventories, an important thing for you guys to note is you need to know what costs are included in measuring inventory and what costs are excluded. Now, one of the important things about inventory or an asset is all costs that are incurred in bringing the asset to its location and condition that is needed by management. All those costs you add them together. So this is the examples of cost. You find them in 4.3.1. It will be your purchase cost. It will be your import duties and other appropriate taxes, your transport costs, your handling cost, any other cost directly attributable to the acquisition of the inventories. So this is the cost that you incur in bringing the asset to its location and condition as needed. Now, if you look at these pictures are always very important. They indicate to you lecturer's comment. So they indicate to you that, remember, for every inventory that you purchase on the purchase price, you must remember if there is any trade discounts that have been given, any rebates, you must deduct those from the original cost. And then you are further given what is excluded as well. It is abnormal spoilage. It is allocation of fixed production overhead costs that were not allocated to production. Storage cost, unless it is essential in the production process. Administrative expenses not related to the location and condition. And then selling expenses. Now, it's very important for you guys to note that in an exam, it is not anyone's intention to trick students, but an exam is always about ensuring that the student who manages to pass knows their work. So everything that is written here in terms of the exclusions, we'll touch on it when we are doing the practical questions. But the most important thing is I want you to remember what is excluded. It's abnormal spoilage if you are given, allocation of fixed overhead costs that were not allocated to production, storage costs, administrative and selling expenses. So you are also informed there that, take note, the costs themselves, despite being excluded from inventory, they are still included in the cost of sales, because remember, it's a cost that you have incurred. So it's not a measurement of the inventory that you are keeping, that you will sell at a later stage, but it is the cost that you are already incurred. So they must be shown on your statement of profit or loss and other comprehensive income on the cost of sales. So most of the time you will see that you keep being referred to the textbook. And one of the reasons why I would also encourage you to also work on the textbook is there is more examples and more questions which are same principles are used for your exam. So this is where you find students complaining and saying, but the study guide in terms of its degree of questions, it's low, it's asking easier questions, and the exam, this is where you get the tougher questions. But the textbook is there to help you and unpack such theories, because the textbook helps you to learn things from basic, intermediate, up until you get to the complexity, and you are able to integrate your work. So the next thing that we also deal with is 4.3.2, which are, you are informed that these are the costs that are incurred in the conversion of raw materials into finished products. So in conversion cost, we are speaking of a production environment where you would start to buy raw materials, where you would need to convert these raw materials into finished goods. But before you can do such, you will need to have your labor, you will need to have other production overheads which are variable, and others which are fixed production overhead costs that you will also have, and of course other costs. And then the correct allocation of overheads, you are also told that it is essential. And then you are given that production overhead costs are incurred in the manufacturing process. We'll deal with all this when we are doing the questions. This is something that you can be able to do as well on your side, but this is something I will try to come back to. So in essence, that is the measurement of inventory. One, when you are adding all cost of inventory, it's all cost involved in bringing the inventory to its present location and condition. So that would form up your inventory. And then that means that you will have costs that you will include to the cost of your inventory, and you will have costs that you will exclude. And from a measurement perspective, we have said inventory is measured at lower of cost or net realizable value, which we'll touch on just now. Now, another important part in terms of inventory is there is something called cost allocation techniques or cost formulas, which you can either use the standard cost, which the standard cost is based on normal levels of operation. This is where you are working on the production side, and the expected costs are estimated by using predetermined information. So when you are using standard cost, you will have your planning, where you've got your budgeted units that you were planning to have. You will have your actual units, and it will work on information in terms of the budgeted units to get you to the cost. Then you've got the retail method, which is using the values of inventories from a selling price and the profit margin and all that. And the other cost techniques that are there, it's your FIFO and your weighted average method. And more examples are also provided in the textbook, but I will try to touch on this as we are doing the examples. And after the weighted average method, we've got the specific identification. So 4.5 deals with the net realizable value. So how do you know what is net realizable value? So 4.5 defines it for us and says it is the estimated selling price in the normal course of business, less cost to complete the inventories, trade discounts, advertising, sales commission, packaging cost, and transport costs. And you are told that inventories are valued at cost at the end of the reporting period, which should not exceed the net amount expected to be realized from sales. Then you are informed that should cost exceed this estimated amount, it implies that inventories are expected to be sold at a loss. And this estimated loss can be measured, and this cost then need to be reduced to net realizable value. And then you have your write-off, and your write-off, you disclose it in the statement of profit or loss and other comprehensive income. So how do you see that you've got net realizable value? What are the indicators that we have to look for? The indicators that we have to look out for are if you are informed that the inventories have been damaged, there's obsolete inventories, there's decline in selling prices, increase in cost to complete the product, increases in selling costs, then immediately all those indicators are telling you that you've got net realizable value. So just to revise again what we have touched, I've said that to determine the cost of inventories, you have to look at the cost in terms of the purchase that you have made. So it will be your cost price, import duties, taxes, any other costs that you may be incurred, such as transport costs, less any rebates or discounts that you have. If you are working in a production site, then we would touch and you would say, when you are looking at conversion cost, you've got to look at variable production, which will be your labor and your raw material, fixed production, which you will allocate at normal capacity. Then you'll have to exclude any normal spoilage or any other selling costs which are not in the production. So we also use allocation techniques, which is your first in, first out, your weighted average method, specific identification, standard costing, retail, or net realizable value. So all of these are called allocation techniques, which are about 6 of them. So there's also slides that you can also find, which you can also find on additional resources, specifically on Learning Unit 4, where standard cost is defined as based on normal levels of production. The expected costs are estimated. When we are looking at the retail method, we say determine the values of inventories by using the selling price, then reducing it by the average profit margin to get the cost. first in, first out values on assumption that items will be sold in the order that they were purchased. So whatever was purchased first will be sold out first. And then weighted average method does a weighted average calculation after each purchase or periodically by taking price and number of items into consideration. And the specific identification allocates cost to separately identified items that were acquired or manufactured. So net realizable value, I've also explained that there is an assessment that takes place where there is indicators. And then we've got a biggest thing, a lecturer's comment that says net realizable value is an entity-specific amount realized from the sale of inventories in the ordinary course of business. Therefore, does not present the fair value. So sometimes you'll be given the value of net realizable value. At times, this is the cost that you'll have to calculate. An important thing now about net realizable value is you are told that for firm sales contract, the net realizable value of these inventories will be based on contract price and not the normal sales price. For raw materials, if it will be incorporated in the finished product, the finished product is expected to sell at more than the original cost. The raw material is not written down below cost. We'll do a question where we'll unpack on this statement. Two important facts about raw materials is raw materials are not written down if finished goods are expected to sell more than the original cost. If finished goods are expected to sell at less than cost, then we have to write down raw materials at net realizable value. So whatever you are writing down will be a cost. So one, whenever we are selling inventory, we have to recognize an expense when the item is sold, which is cost of sales, and we have to recognize a revenue for the items that have been sold. So in the cost of sales expense, what we have to include is the inventory that has been written down due to either damage, due to reduced prices, whatever it is. We have to recognize the cost of the write-down or the write-down expense and add it to the cost of sales. And the write-down, you must remember that inventory written down is also what you also need to disclose when you are doing your profit before tax note. It's also one of the items under the expense that you have to disclose. So the net realizable value can also be reversed. So let's say we initially thought that the stock was lost or stolen, but later realized after the accounting has been done that actually that inventory has not been lost or stolen. So now we have to reverse the net realizable write-downs. So we have to reduce the cost of sales expense that we at an earlier year that we recognized in the statement of profit or loss and other comprehensive income. And then the disclosure touches upon the accounting policy, which says inventory is measured at lower of cost or net realizable value. And they tell you that if you've got any write-down, you have also to mention it in the disclosure note at the bottom and any reversal therefore. So example one, it's something that I believe that you guys can be able to do, which is question one. It's just about calculating the net realizable value. And then immediately after calculating the net realizable value, you'll be able to compare it with cost. And then immediately you'll be able to calculate your closing inventories by either lower of net realizable value or cost. So what I want us now to do is to go and do a question, which is question 3 on tutorial 102. So question 3 will only focus on We'll only focus on the inventory part. Remember with the mind that what we actually want to do is to focus on the self-assessment question. So question 3 informs you that the following information was taken on 31 December 2011 from the accounting records of Apple Ltd, a manufacturing company. Now, we already know that once we speak about a manufacturing company and we're touching on inventory, that we're definitely going to have raw materials, we're going to have work in progress, and then we're going to have finished goods, because this is a production environment. So we're not speaking about the retail environment where you will have only opening and closing, but we're speaking about where we are actually producing. So if you continue, there's a line item called inventories, and it tells you that inventories, additional information number 4, inventories are 390,000. So before reading what number 4 is, we read what is the required. So the required says prepare only the asset section of the statement of financial position. So this simply means that all now we have to do, it is to calculate the inventory that must be disclosed in the statement of financial position at year end, which is the 31st December 2011. So that's basically what we have to do. So let us now go and look at number 4. So note number 4 of inventories is this. Remember, on the balances, we were given inventory and we were told that inventory is 390,000. And now we actually come here to read the note about the inventory. And here we are told that inventories consisted of the following: at 31 December 2011, cost price in brackets, so which means that you are being given now what is the cost price, and on the information we are told that raw materials 140,000, work in progress 200,000, finished goods 50,000, and then the next information tells us at 2011 year end, the directors determined the net realizable values of the inventories were as follows: raw material 5% below cost, work in progress 5% above cost, finished goods 5% below cost. So now the question then stands. I want you to remember what we discussed when we talked about inventory. We said inventory is measured at lower of cost or net realizable value. So that's what we know about inventory. So now we have to calculate how much inventory should be disclosed at the end. So we've got 3 net realizable values. 3 net realizable values. Just want to open quickly a new sheet. So we've got inventory that we want to disclose. So this is the calculations that we want to make in terms of inventory. One, we know that we've got raw materials, we've got work in progress, and then we've got finished goods. This is your production environment. So the cost that you have been given, so I'm going to show you, this is the cost that you have been given. So they've told you that They've told you that in terms of the cost, raw material is 140,000, which is 140,000. They've told you that work in progress is 200,000, and they've told you that finished goods is 50,000. I just want to quickly format my cells in terms of the currency that we're using, the South African currency and not the dollars. You can just bear with me. Right. So those are your costs represented by rents. And this is what you've been told. This is your NRV. And in terms of your NRV, what you have been told is that all of them are at less than 5%, which means that all of them are actually so basically this is what this says. Is that your raw materials is 140,000 at cost, work in progress 200,000, finished goods 50,000, and then if you calculate your net realizable value, your raw materials of 95% will be 133. Your work in progress of 95% will be 190. Your finished goods of 95% will be 47,500. And eventually, we want to know, in terms of the inventory, in terms of the inventory disclosure note, which one must we take now? One, work in progress is never at net realizable value. So work in progress is always at cost. Remember, it's the conversion cost. It's your direct labor, your raw materials, and other variable production overheads and fixed production overheads. So this is always not reduced to net realizable value, your work in progress. Your raw materials and your finished goods, these are the two now that we have to look at them. And I want us now to remember what we had covered in terms of the raw materials. In terms of the raw materials, 4.5.2, I want you to remember what we said. We said, if it will be incorporated into the finished product and the finished product is expected to sell at more than the original cost, raw material is not written down below the cost. If, however, the finished good is expected to sell at less than cost, it should be written down to net realizable value. Now, this says now we must look at what the directors said. The directors have made a decision that inventory finished goods will be sold at 95%, which means it will be sold at 47,500, which is lower than the cost. And now the standard says, if then finished goods are expected to sell at less than cost, then this means that you must write down raw materials. So which means your raw materials balance now will be 133,000. Finished goods will also be written down to 47,500, which means that your value of your inventory is going to be 380,500. Now, remember on the balances that you were given initially, you were told that inventory is making 390,000. So this means that there is a right inventory written down, which is an expense. Inventory written down, which would be an expense. And how you calculate this one, it will be 140 minus 133, and then it will be 50,000 minus 47,500, which would be 2,500, and then that would mean that your inventory written down would then be 9,500. This 9,500, when you are doing your statement of profit and loss and other comprehensive income, you'll say revenue, you'll say cost of sales, and then on your cost of sales, you'll have a calculation that you will refer to here. And then on your calculation, which is the calculation of determining the cost of sales, you will indicate that, so you'll have a balance here, whatever balance it is that you will have for cost of sales. Then you will indicate that you also have got inventory written down, which is an expense, and this is going to be your 9,500, which is the inventory that is written down from your raw materials and from your finished goods. That is the 9,500. If you were asked to do profit before tax note, so in your profit before tax note, you say these are the items that have been concluded as follows before profit before tax note. Then you will have the statement here that you will put that says the following has been accounted for before profit before tax, and then you will have your income, and then you will have your expenses. Under your expenses, this is where now you will show your inventory written down, which will be equal to 9,500. So I'm just showing you that principles inventory is measured at lower of cost or net realizable value. So on this question 3 of 102, you have been given the cost of raw materials, work in progress, and finished goods, and you have been informed Apple Ltd is a manufacturing company, which means that you are in the production. So you've got your cost made up, and then you are told that your net realizable value has been decided by the directors at year end that the inventories will be sold now at selling price less cost to sell. So just to remind you, let us go back and look at what was the definition of net realizable value. So the definition of net realizable value on 4.5, we're told that it is the estimated selling price in the normal course of business. So which means the directors in note number 4 have decided that in terms of the market conditions that they have seen, that these inventories that have been produced in the manufacturing will now be sold at the following selling prices: raw materials 5% below cost, work in progress 5% above cost, and finished goods 5% below cost. So we did something wrong on work in progress. It's actually 5% above cost, which means it's 105, which is 210. So the lower will still be your cost in this instance. So this is basically the calculation that you do when you are doing this part of inventory. You're saying cost, raw materials 140, net realizable value, if it's below 5% at cost, it will be 133. Work in progress 200,000. If it's 5% above cost, it will be 210,000. Finished goods, it's 50,000. If it's 5% below cost, it's 47,500, which means that your work in progress, you're measuring lower of cost or net realizable value, which is your 200,000. Raw materials and finished goods, you have to revisit that principle that says if finished goods are expected to sell above cost, then you don't write down inventory raw materials. In this instance, finished goods are expected to sell below cost. Therefore, we have to write down raw materials and we have to write down finished goods. So I hope I've just explained now that example on question 3. I don't know if there's any quick questions that one wants us to cover in terms of question 3 before we move to the next one. Right. All right, let us then move to the next one. So the next one that we are going to be covering is your question, which is posted on additional resources. It's posted on learning resources. It's your question now to expand on the knowledge on inventory again. So here is the question. It says the following balances were extracted from the record of Sonic Sport for the financial year ended 28 February 2017. Additional information, cost of sales, then they refer us to additional information number 2. Inventory at year end, question mark. Additional information, which is now this information that we are referred to here for cost of sales. We are told that Sonic Sports Ltd's inventories consist of the following: raw material, opening, closing, net realizable value, work in progress, opening, closing, net realizable value, finished goods, 400,000, 355,000, and net realizable value. Packaging material, 71,500. Closing, 61,500. 60,500 is your net realizable value. Right. One thing that I want us to quickly take note of is that this part here of opening and closing is actually the cost price. So this is actually the cost price, and the NRV is the net realizable value. So that's something that I want you to take note in terms of these two columns. So the net realizable value is only compared to your closing and not your opening. So your opening, the net realizable value is only compared to your closing balance. So we read the information further. It says The following information was extracted from the accounting records for the year ended 28 February 2017. Sonic Ltd values raw materials and work in progress according to the FIFO method, first in, first out method. Finished goods and consumable are valued using the weighted average method. Finished production overhead costs are allocated at 140 rand per unit based on normal capacity of 15,000 units that were produced. So another thing that I really want you guys to note is these terminologies will not be used for exams. So this is just used for now temporarily because this was just a self-assessment question. So on your description, you are given the cost, which is your raw material purchases, transport costs, raw materials, variable costs, fixed production overhead costs, selling expenses, and this is the required. 1, determine the cost of sales figure to be included in the statement of profit or loss and other comprehensive income for the year 2017. And then your number 2, determine the amount to be disclosed as inventory in the statement of financial position for the year 2017. So this is what this one says. So I want us now to go and try and attempt this question. So we'll try with dealing with number 1, and then eventually we will deal with number 2. So what I've done is I have prepared this table in the meantime, and I will explain to you so that you understand it. In terms of the production, in the production environment, you buy raw materials, and the raw materials are converted, which means that you take the raw materials that you have purchased, and then you transfer them to a work in progress. In work in progress, you'll have guys that will be working in terms of time from labor perspective, that will take the raw materials, combine it with labor and other costs, and then your work in progress will then transfer to the finished goods, and then your finished goods will then be your closing stock. So I want us now to start working on the figures that we have. So that is why I have this table, and that is why I've got your opening stock, your purchases, any other cost, such as your transport cost, your selling cost, whatever cost that are incurred to bring the inventory to its location and condition as needed by management, less anything that we will transfer out. And then when we are touching on finished goods, it will be your revenue, which is your sales. But as we are dealing with raw materials and work in progress, we are speaking about transfers. But once we deal with finished products, we talk about your sales, what you have sold, which is your cost of sales. So then you've got your closing stock. So this is the format that you use in the production environment. So we'll start now with the opening stock. So we'll go to the question. So raw materials on information number 2, additional information number 2, we are told that raw materials has got an opening of 350,000. There we have 350,000. Let me try to make this bigger for those who and also to put it in the middle. Right. So this is all is represented in rands. You've got your opening stock, which is 350,000. Now, if you are looking under information number 3, you are told there that raw material purchases were 750,000. So raw materials purchases were 750,000. Other costs, do we have any other costs? We look here on the information again. We are told that transport costs for raw materials 125,000. This means that all costs to bring the inventory or the raw materials in this case to its location and condition. So if we had things such as your insurance costs, would also put it there, 125,000. Anything else about raw materials mentioned here? No, nothing else is mentioned about raw materials. We are also given a figure for raw materials as 250,000. Now, the question now arises which says, why is your closing balance not 225,000? Remember, in this calculation, we are calculating cost of sales. After calculating cost of sales, we will come back then to your question, because now we are trying to calculate work in progress, raw materials, and finished goods. And then after that, we will calculate cost of sales. And then on number 2, required number 2, we'll calculate the inventory valuation. This is when now we will try to apply the law of cost or net realizable value. So we've got our closing stock here, which is 250,000. So this means opening plus purchases plus other costs, which were transport costs, minus the closing stock gives us 975,000. Please don't mind the signs. I've just changed the signs so that we are able to also do this in terms of the you understanding the deductions and whatever. So we're saying opening stock plus purchases plus other costs less closing stock gives you your transfer. What do you need now to be transferring to work in progress? So this means that under work in progress, we're going to have under transfers 975,000 that comes from work in progress. Remember, on work in progress, we also have its opening, and we also have its closing stock. So on opening, we'll have 225,000, and then on closing, we'll have 275,000, 275,500. And the question then is, on work in progress, do we have any other cost? And the answer is yes. Remember, in work in progress, this is where now you would have your other variable production overhead and fixed production overheads, which is your labor that you are using, plus other conversion costs to actually develop a finished product. So we'll have a calculation here to calculate work in progress, other costs. So we've got variable production overhead costs, which we are given. They say production overhead costs are 1,250,000. 1,250,000. One. And then we've got fixed production overhead costs. Now, fixed production overhead costs, They are also given, and you've got 2,250,000. And if you are reading there on the statement above here that I've highlighted, it says fixed production overhead costs are allocated at 140 rand per unit based on normal capacity of 15,000 units that were produced. Now, I want us to go back now to the study guide. Now, in the study guide, when we are talking about fixed production overheads, all right, I'm not going to get it that quickly. But fixed production overhead all right. All right, this, you will quickly get it on a textbook, but it will, the information will tell you that fixed production overhead are expenses that do not change as the level of production changes. So variable production overhead costs by definition are expenses that change, that are variable with the production. So as production changes, your variable production overhead also changes, because there you are dealing with your labor. Here you are told that you are dealing with your labor. Yeah, here it is. Variable overhead costs can be allocated with ease by using the number of units manufactured. So it means variable overhead costs vary according to the number of units that have been manufactured. But fixed production overhead costs use normal capacity as basis. So for fixed production overhead, it does not matter what has been produced. You always allocate fixed production overhead according to the number of units, according to the normal capacity, according to normal capacity. So which means in the information here, we are told that fixed production costs are located at 140,000 and based on the normal capacity of 15,000 that were produced. So which means in this calculation, we are going to say 140,000, 140 rand multiplied by 15,000, which is going to give us 2,100,000. So basically 140 per unit multiplied by 15,000, which is the normal capacity, which is 15,000 units. So this is your fixed production overhead. And then that takes your other cost totals to a total then of 350,000. And this is the cost that we're looking for here, which is 3,350,000. So you've got all your costs here. So you've got to add all of them together, less closing stock, and this will give you the amount that you are transferring to finished goods. So in this instance, we are going to say this plus 975 plus 335. Then we are going to say minus the closing, which is going to give us 4,274,500, which we are going to take to finished goods, because we're transferring work in progress to finished goods, 4,274,500. 500. Now on finished goods, we also have its opening balance. Opening balance for finished goods 400,000. And then do we have any other costs that were incurred? We go and we read the information. We do have other costs that we incurred, and those costs are called selling expenses. Now, if you remember, now we are almost done with inventory. Now, when we defined inventory, we said when you're looking at the measurement of inventory, we said the measurement of inventory, there are costs that you include and there are costs that you exclude. So we said that one of the costs that you also exclude is your abnormal spillage, it's your selling expenses, which are, and your storage costs, which are not essential for your production. So that is what we are talking about in such instances. That is the cost that we are talking about. Therefore, we don't have no cost when it comes to that part. Then the next thing that we are looking at is your sales. We won't know our sales until we have captured our closing stock. So our closing stock for finished product is 350,000. 355,000, sorry. 355,000. So our closing stock, 355,000. Therefore, now we are able to calculate how much of our finished good is actually going to cost of sales by saying 400,000 plus your transfers that come from work in progress. Please bear with me. Let me see, what am I doing wrong? It's your opening plus your transfers, less your closing stock, which we're going to add at this point. So that is how much is your cost of sales, 4,319,500. Remember, at this stage, we have not dealt with the required. All that we needed to know was how much from finished goods is actually cost of sales. So we are now going to start to deal with the required. So the required says calculate the cost of sales figure to be included in the statement of profit or loss and other comprehensive income at 28 February 2017. So under cost of sales, we've got finished goods that are coming here, and the finished goods is is 4,319,500, which is this 4,319,500 that is coming from finished goods. Now, you have to note that these finished production overheads to 100,000 is not equal to the cost that we have been given here of 2,250,000. This means that we have now to increase our cost by the difference, because now we have under recovered. Under recovered because we expected that at normal capacity that we were going to have 2,100,000, but we only have 2,250,000. So which means therefore we have under recovered, and therefore we have to increase our costs. I'm going to demonstrate this now. This is the under recovery, and this comes from saying 2,250,000, which we are given there, minus what we have calculated, 2,100,000. So what does under recovery mean? This is something that now I just want to quickly help you by reading it on a textbook for you, so that you are able to determine the two things being the under recovery and the over recovery. Right. So now let us go to so you are told here that these costs are incurred: direct labor, variable production, fixed overheads based on normal capacity, and they explain to you the story. Okay, they do not explain it there. But in this case, what has actually happened is we were expecting, in terms of the normal capacity, to incur cost at 2,100,000, but we actually have a cost of 2,250,000. So what this then says is, if the production levels are lower than normal capacity, the fixed overhead recovery rate is not adjusted, and the under recovered portion is charged directly to the profit or loss and other comprehensive income, forming part of the cost of sale expense. So in this case, we are not told how many units we actually produce, but one can be able to deduce that the production levels are much lower. Therefore, the under recovered portion has to be, because fixed production overhead is always allocated at normal capacity, which is at 2,100,000, but we have incurred 2,250,000. So which means that we have under recovered in terms of our calculation. When we were calculating the work in progress, we should have used 2,250,000. So now we have to increase this amount here, which is basically made up of 250,000 minus 2,100,000, which gives you 150,000. So this balance here is for under recovery, because we allocated inventory at fixed production overhead cost at normal capacity, and then later on, the actual cost that we incurred, here, fixed overhead production costs are 2,250,000, which means that we are under recovered by having used the 2,100,000. And its principle you have when you are allocating work in progress, to allocate fixed production overhead cost at normal capacity, but then you only adjust it by charging it at statement of profit or loss and other comprehensive income on cost of sales. So let's say if the amounts were vice versa, we were going to say it's over recovery, which means that this amount would have been 2,250,000, and this amount would have been 2,100,000, the actual cost. Therefore, we have over recovered. Therefore, we have to reduce the amount that we used in working in progress amount. So this is the 150,000 that we have to charge, increase the expenditure because we only use 2 million rand on the production side. Now, let us go back now and look back to our question now. I want you to remember the principles that we dealt with previously. And I want you to take note of the following. You are told raw materials and work in progress. Raw material and work in progress, they are valued according to the FIFO method. Finished goods and consumables are valued using the weighted average method. Now, you are sitting there with two cost formulas applied to your question. And now you are thinking, is there, in terms of the closing balances here, between these two columns, closing, the NRV and the closing cost price, the question that arises now from you should be, how will I determine the raw material if I am using these different cost allocations? And the answer is simple, is the fact that when you are looking at the raw materials, we look at the question of whether are we going to sell the finished goods at lower of cost or above cost. So we already see our finished goods is 355,000 and our selling price, which is our net realizable value, is 385,000, which means we are going to be selling above cost. In such an instance, it means that we do not write down our raw materials. So our raw materials cost price is more than the NRV. So if you are looking at the inventory measurement principle, you measure at lower of cost or net realizable value. Similar with work in progress. But because we are expecting to sell above cost, which means that our cost is 355,000, we're either going to sell at cost or above cost and not at less than cost. Therefore, raw materials and work in progress will not be written down. All right? Then the next one is finished goods. Finished goods are 355,000, NRV is 385,000, lower of cost or NRV, lower of cost is 355,000, no write down. But now we come here and we look at something called packaging materials. Packaging materials, one can assume when they are saying finished goods and consumables, they are referring to packaging materials. Packaging material closing cost is 61,500, NRV is 60,500. So this simply means that there is a write down that you have to be doing here. So how do you do the write down? So this will be your calculation 2, dealing with packaging material or consumable. So they've used the word consumables. So you've got consumables, closing balance, cost price, remember, which is 61,500. And then we've got consumables closing balance at net realizable value, which is 60,500. So what does the definition say from inventory perspective? It says inventory is measured at lower of cost or net realizable value. This is what the principle says. This is what the principle says. Inventory is measured at lower of cost or net realizable value. In this instance, your consumables would be measured at lower of, which is your net realizable value, 60,500, which means that you have to have inventory write down in this instance of 61,500 minus 60,500, which is your 1,000, which means that you've got inventory written down from consumables. You reference it, calculation 2, and this would be your 1,000 rand that you have got in there, which you charge against your cost of sales. So the next thing that you're looking at now is calculating what is your value of your cost of sales. So the value of your cost of sales in this instance would be 4,470,500. 4,470,500, which is your total cost of sales. So we have completed question number 1, which asked us to do cost of sales to be included in the statement of profit or loss and other comprehensive income. So this would be how much would be included in your cost of sales. So this means, in other words, if you were to do your statement of profit or loss, you would have Sony Sport Ltd. Then you will have your statement of profit or loss and other comprehensive income for the year. And that, just quickly thinking of the date, 28th February 2017. And you will show here the amount. Then you've got the revenue. Then you would have here cost of sales. This cost of sales here would be this amount here that you received here of 4,470,500. So this is how much your cost of sales would be, 4,470,500. So number two says determine inventory to be disclosed in the statement of financial position. So for us to determine this, we have raw materials, we have work in progress, we have finished goods, we've got consumables. Remember, we have already tackled this question. So we have said that the closing balance for your raw materials will be 250,000 and your work in progress will be 275,500, because remember, on these two, we said, our argument said, if finished goods are expected to sell at cost or above cost, raw materials and work in progress is not written down. So fortunately, when you're comparing your finished goods closing balance and your NRV, the lower is your finished goods, which is 355,000. So here we're using the cost price, and similarly here we're using the cost. But when it comes to consumables, we have already done this question. Consumables, we are disclosing them at net realizable value, which is 60,000, 500,000, and this brings your total of your inventory that you are going to be including in your statement of profit or loss, statement of financial position, as 910 of 41,000. So similar thing would happen there as well. Because what you are going to do, if you are doing statement of financial position, you are going to say statement of financial position as at 28 February. Then you're going to have non-current assets. And then eventually, you're going to mention them, your PPE, your investments. Then eventually, you're going to have what you call current assets. And then on your current assets, you will have your inventory. And then you will have your trade and other receivables. Then your inventory would be 941,000, which is this 941,000 that we have calculated. So when they say do an asset section, this is how you would be taking your inventory to your books. So this basically is how you do the calculation for your inventory. So that means that we have done number 1 and we have done number 2 of our requirements. Now, that does not only end there. I want you to please, if you do not have the textbook, try logging on to the library page, library at UNISA. See if you can be able to see electronic books. Try to find the IFRS book. There is more examples in terms of the introduction to IFRS, which I will not be able to cover in the time that we have, where you'll have examples that will cover the cost techniques, how you deal with your FIFO, more examples on allocating your weighted average method, how do you calculate it, how do you weight, FIFO, how do you calculate the units and the closing stock, specific identification, and more examples on net realizable value. So unfortunately, I cannot be able to cover everything, especially with the time limit that we have. But the important thing is for you to be able to learn this table that I have created here, not only the table, but the principles that if you are calculating finished product sold, it's opening stock, then it's transferred from work in progress, and then it's closing balance, and then you get your cost of sales. So this will be your cost of sales. If you are doing work in progress, you have to understand this column, that it's opening inventories, which is your opening. It's any purchases or transfers that you have from raw materials. It's other costs, which is your labor, variable production overheads, fixed production overhead, which is only allocated using normal capacity. And then you have your closing stock, and this is your transfer to finished goods. Raw materials, your other cost would be whatever you are given, which may be raw materials, purchases, opening and closing. Remember, always excluded, it's abnormal spillage, selling cost, because all of those, they are actually included when you are calculating your costs of sales. Like the under recovery or over recovery would be included here. Inventory written down. If there was any abnormal spillage, it will also be charged against cost of sales. So when we are dealing with under over recovery, we say fixed production overhead incurred at normal capacity less what you actually got in terms of the actual cost that you incurred. So that basically takes me, I will try to, for anyone who might need it, I'll try to share try to share the slide that I've created. Sorry, not the slide, I mean the Excel sheet where I use to calculate everything. But quickly, I just want to check if there is any questions that you may have. And for administration, before I give over the questions, the next class that we'll be having will be working on property, plant, and equipment. And one of the things that we'll be working on there is basically to tackle the issue of depreciation. Those that attended the second class would remember that we did a question paper for October, November 2016. I just want us to do the depreciation, understand depreciation expense, capitalized, revaluation surplus, and then we'll tackle question 2 and focus only on PPE. And then there's a question 3 as well that I want us to focus on PPE as well, which will be capitalized. So next week on the 23rd, same time at 11 o'clock, 23rd of April, we'll be dealing with PPE. And those are the things that I will want to deal with. But I just want to take any questions that you may have related to what we covered today. And please note, if you do not get a chance to ask questions, you will also have an opportunity to put it on the charts. Email ctn.unisa.ac.za. Then I will be able to answer there as well. I will also leave my email address on the chat so that you are able to send your any queries that you may have. It's yudisani.mpc@outlook.com. You click on a chat part, and then you will find my email address there. So let's take, is there any questions that you may have? Any questions that you may have? All right. I've got a question that comes from Con that says, I have a question. What would you do for part 1 if fixed production overhead was more? Right. Right. Let us try to tackle that part of the question. I will try to share this part. I hope that this will be able to appear on the screen whilst we're tackling this. So the question that is being asked by Con is, I want you now to know that we are making an example. Sorry. Right. Example on fixed production overhead. Now the question is, what happens if the actual cost, so let's say the actual cost here, the actual cost in the question that you are given was 2 million. That's what the question is asking. If this was 2 million. So if this was 2 million, I'm going to explain this now. This means the actual fixed production overhead would have been 2,100,000. have been 2 million, but the fixed production that you are allocating at normal capacity would have been, sorry, this is 2 million. And this is 2,100,000. Now the question is, what happened if this was given in this way? So what we have in terms of the fixed production overhead is 2 million, but fixed production overheads allocated normal capacity is 2,100,000. So what will happen is, when you were calculating your work in progress, you would have used 2,100,000 to allocate your work in progress, which means the actual cost is 2 million. So this means you have used over more production overhead. So which means you have over recovered. So to charge against cost of sales, we have to reduce that by the 100,000 because you have over recovered by 100,000. So this actually reduces your cost of sales, because remember, your cost of sales is made up by this mapping that comes from raw materials, work in progress, finished goods. So on work in progress, you actually over recovered on a normal capacity, which has actually increased the cost of your finished goods. So you've got this 100,000 extra that is sitting here that you have over recovered with. Now here you have to reduce it, but you only reduce it on cost of sales. That is the 100,000 that you are reducing it with. And therefore, this becomes an over recovery. And under recovery, it's when your fixed production overhead is less than your actual incurred. And the over recovery is your actual fixed production overhead is less than your that you have incurred is less than the normal capacity. Please look at these two examples as well. Then you will be able to understand it better. But I hope I did try. Any more questions? No more questions? I will send this information. I believe that it will be posted by UNISA, the Excel sheet that I've created, for anyone who might want to use it, specifically with the exams that are approaching, since it's going to be a non-exam, venue-based exam. I don't know how you are going to deal with it. I've been informed, thank you, Con. I've been informed by one of the students that attended my class who does not write exams using a pen. She uses a computer. So I hope what I'm going to send will be helpful to her as well. The Excel sheet, I'll ask UNISA to disseminate it to you as students. And please, at this point, really, during this pandemic, we are all unsure, but I'm sure there will be an announcement that will be availed in due course. But I will be sending this Excel sheet so that you are able to practice using Excel as well, the Word, anything, so that you are prepared either way that you have got to write your exam. But with those words, thanks everyone. We meet again in this platform on 23rd April 2020 at 11 o'clock. Thanks everyone. The class is then adjourned. Thank you. And the information of the recording will be availed by UNISA they will inform you where they will put the recordings on. Thank you.